not something that they look at positively?
Yeah, Maharaj. So it's a right thought process. If you look at last 5 years in India, the entire country has become now this sort of investor from saver, or you can say investor from trader. Demat account growth is 5x in 5 years. Effort volume is multi-x. So obviously, mutual fund SRPs have gone to the rooftop. So in India, capital market participation has gone. Now in F&O, I think excesses was created, and any regulator would like to check that excesses. And the primary purpose of regulation is to ensure that there is a orderly growth. And to that extent, the 6-step strategy which regulator has proposed, I think is the right step, and definitely that would get the desired impact. We have already seen a couple of measures coming in play, and we have seen some impact coming in terms of cooling down of the volume, particularly at the lower end of retail. So I think the measures are calibrated in a staggered manner. It is not disrupting the entire market, but it is achieving a desired impact over a period of time.
Phase of growth for digital payments, where is that going to come from? And Riju, you can chip in here as well in terms of the impact of payment gateways. Because I remember last year when we spoke to you, you said, payment gateway is sort of the graveyard where fintechs come to die because of the lack of monetization opportunities. But has that improved?
Just to correct you, so you look a bit more like digital gateway. It took 5 years ago. Last year was already playing out. No, I think what one needs to perhaps debate, maybe not in this session, is what does growth mean. The other part, I think payment growth, if measured by volume and metrics, is purely going to come in terms of number of small value transactions, number of credit transactions as an overlay to an underlying debit transaction. Those are two areas of growth. Pretty much a no-brainer that is a majority, if not a dominant portion of them, will come on the rate of growth. The one difference that could be in terms of the next 3 years compared to the past 3 years, a lot more transaction will come from what we typically call the tier 3, tier 4, tier 5.
The Bharat, the so-called Bharat 2, Bharat.
Yeah, many of them will come from those markets. I mean, a large part of the growth will come from those markets.
Maybe if we can speak at a very short level, I think I will speak about looking at UPI more not as a local domestic payment mode, but as a global payment network, which means allowing other networks also to kind of transact on UPI. I think that can unlock a large share of growth, which would be a lot of cross-border payments, right? Foreign people coming to India. So I think when we look to take UPI global, I think that global probably starts at home, right? And this is probably an intro, like not UPI, that's something that can unlock.
Even a catalyst to further strengthen the agency force and the business to be done with them. That's what we look at it. We would like to enable our agents much more technologically so that they are able to do a much better performance than what they are currently doing.
And to turn to you, Mr. Rao, now beyond distribution, technology also has a role to play in underwriting. You've been using that tool, besides of course in sales and distribution. So could you talk about how it has evolved and what kind of value addition has it made to these functions?
Actually, there are two aspects of underwriting. One is medical and of course the other is financial. Insurance industry has a huge amount of data. We worked at data, we've been present for the last 20-25 years, so we've used data of the past. Today we have a tool where about 50 or 55% of the policies that we issue, no human being looks at the policy. It's a tool which we have jointly developed with an insurtech company. And it gives you a picture of what is right or what is not right. It gives that for 100% of the policies that we source. But basically the accuracy ratio at which it predicts or gives a response, and when we were doing the initial work, the statistical relevance of that model is close to about 90-95%. So it's a great tool, productivity goes up, ability to be able to issue a policy much faster actually kind of goes up. And the hands and legs it provides in all areas. saying today there are bots with voice assist that are able to answer customer queries, claims through AI developed models. Typically, two things happen. One is the claims that are supposed to be paid faster, it's paid in the fastest possible time. And B, if there is somebody who's trying to fraudulently bring in a claim which is not appropriately right, that also gets detected through AI models. So I think my view is there's a lot of great work done by insurance companies. If we embrace that together, I think it's going to be good for the insurance companies in the future.
And
25 years for us to fully maximum. And that's based on evidence. And primarily, I'm looking at when countries start to change, it's a long run cycle. It doesn't happen very quickly. And we have a case study, a live case study of China, which started transforming probably somewhere in the mid 90s. By 2000, it had started accelerating. And the cycle really went in 2015. And we have to go through several stages, whether it is infrastructure getting built, rural, urban, transportation, everything will build. Manufacturing kicks in. Then services actually takes to a different level. Technology. So if you look at each one of these, we are at various levels. But there's so much to do when you see what has been done elsewhere. And along this way, you have a GDP that will accelerate. And that itself creates another cycle. So it's a long run thing, at the end of which I would expect India to virtually be at the top in terms of overall GDP, and then interest rates being stable. That's what you saw in say, China, Japan, and elsewhere. Inflation being stable, and the currency being strong. So these are the end state conditions. To reach there, I think it's a 25-year journey. What could have constrained us is lack of opportunity. I don't see any lack of opportunity. So the path is clear. You know, small hiccups will happen depending on what's happening geopolitically or internally. But these are all small, say, bumps in a long journey.
You were actually a pioneer on investing many of the internet products back in the day.
It is a vanishing, only started with. Car was free since that's a bank, because it didn't pay any. But now, if I have the ability to move car into an overnight product, which a mutual fund offers, which is basically picking up the appropriate maturity and then bringing down. Again, zero, you get even 5%. Why will money stay? So this sort of a transformation is happening at a dramatic pace in terms of what is happening, and that is accelerating. So to bring it to the question you asked, the shake-up has started at broking level, and it will go up the more difficult terrain, as it were, of financial services. But it's going to be everywhere as it were.
So you made an interesting point about the rate of change is frightening, and it's funny, when I speak to even founders in the AI space, they themselves feel the rate of change is frightening, and we are all kind of seeing the effects of this around us. But I say financial services businesses are built like institutions. They're usually built to outlast people who have built it and outlast thing. How do we manage these dichotomies, right? Because like shelf lives, I believe of businesses should be challenged as time progresses, right? But how do you kind of manage both the things together?
Yeah, I think shelf lives will continue to be challenged. For that to continue to be challenged in the future, you need, I would say, the regulator to have the appropriate outlook, as it were, on how and what it would allow you to do. And take banking as an example. They've done the exemplary job of letting everything into a sandbox, and vetting it, making sure that they are comfortable, and then allowing it to be scaled up. There, the fintech would have probably been able to pose a bigger challenge, but certain revenue streams are constrained. Other than that, in terms of product and we are probably offering the best in class globally. Now, other businesses in the financial services sector need to actually introspect and see what is it that I can provide to make my customers more, happier and more satisfied. I heard that earlier panel. It was very interesting, and there was a point made that customers should understand what is being sold. I can tell you that I, as a customer for a car insurance, don't understand what it means. So when somebody says that this one costs so much, this one costs so much, and they use phrases zero debt and something, I really don't know. So I'm saying, why don't you first put out a sheet saying these are the catchphrases or terminologies we use. This is what it means, and this is what it should do in terms of cost. Then putting a comparison sheet for 5 people. No, it's not done. So now, who's responsible for this? Each company should say, if you're putting out my product, please put out these things. So the customer has an understanding of what it is. So in some areas, we are not even at what I call ground floor level. So you have to go up. Second, you call up for renewal of, you get a notice for renewal of car insurance, you call up somebody. Then you pay, then you get another reminder 7 days